All right, let's get started with the first conversation today, and that relates to the post-tax or the post-cost returns to your investments. A lot of the times, even in coffee table conversations that you've had, you will recall that people talk about the returns that a particular investment gave them. If you're talking to someone of a certain age, then they'll say that they invested in real estate back in the early 90s or maybe even before that, and their returns have been absolutely stupendous. What they don't tell you is the amount that they've paid in the interim, what the impact of cost and taxes are on those returns. My next guest is Arvind Rao, who is a certified financial planner, a chartered accountant, and the founder of Arvind Rao Associates. Thank you so much, Arvind, for taking the time. I want to start by asking, you speak to a lot of people on a daily basis and you give them advice on their finances. How many of them really focus on post-tax and post-cost when they discuss returns with you?
Very few, Alex. And I think somewhere a lot of people have slowly started realizing that in the last few years, the tax laws have got even more, you can say, stringent in terms of leaving hardly any investment instruments available for investors which are in the tax-free zone. Like I think most of our viewers here may be aware that it's been a year now that things like dividends on equity shares and mutual funds too are no longer tax-free. So in fact, I think one can, barring PPF per se or the EPF for organized sector, there is hardly any instrument left today which offers tax-free returns. And when we talk about financial planning or financial forecasting, generally it is all about assumptions and uncertainties. And amidst all this, what is certain during this long period of planning is, of course, taxes, which are certain, and the rate of taxation is certain too. So it's high time people take note of this and factor this in when they are doing their calculations for the long term.
Well, you know what they say, tax is one of those things in life that is absolutely certain. But let's talk about this in a little bit more detail. What are the implications, Arvind, according to you, of not factoring the cost or tax when you are making your forecasts, which you say are anyway fraught with uncertainty? What are the implications of going wrong with that?
Implications, I would say, will depend case to case. But in certain cases where the tax rates are pretty high, and which could be as high as 35 or even 40% nowadays, in these cases, ignoring taxation could imply that one is overestimating the returns that their money put away by almost, you can say, even in sometimes as high as 1/3. So when you are estimating the growth of corpus, ignoring the tax impact, or for that matter, even there are other incidental costs to holding an investment in addition to taxes. So ignoring these could mean that the numbers on a sheet or on a paper would be overinflated by as high as even 1/3, while reality could be starkly different. And what this could mean is that if not catered to or handled at the right time, it could lead to disappointment for investors when they are close to their milestones or the goal maturity, where they find that when they have to now look to liquidate this money, if there is some amount of money that they have to shell away on taxes, it leaves them with lesser money in hand. So it could be dangerous. Specifically, if one is talking about goals like retirement, when people, when they retire, would not be having any means to earn active income beyond retirement. So what it means is, if ignored and if taxes and other costs happen to take away some part of the corpus that they have already accumulated, they would be heavily disappointed at that point, because there is no way left for them to recover this money at that given point in time.
Fair enough. Let's break it up, Arvind, so that everyone benefits from this conversation and that they can now, going forward, plan accordingly. So let's talk about the various asset classes. Let's start with equity, and we can talk about both individual equity shares as well as investing through mutual funds. What are the taxes that one needs to bear in mind? It's primarily capital gains tax.
Yes, in fact, let me divide this bit into two parts, which is the capital gains. Now, in this case, whether it is equity mutual funds or equity shares, if you are holding them for less than 12 months, any gains made on that becomes a short-term capital gain, which will be liable to tax at 15%. And in case you are you are gaining capital gains by holding these funds or shares for more than 12 months, then it becomes categorized as long-term capital gains, which will be taxable at 10%, subject to a threshold of 1 lakh per year per investor, which is not taxable. Anything beyond this is liable to tax at 10%. The second bit on this, which is the regular income that one may get out of these equity investments, is dividends. And as I mentioned sometime back when I spoke, the dividends too are now taxable. Now here, dividends are also liable to withholding tax. So companies or mutual funds, when they distribute dividends, if the total distribution of these dividends is exceeding 5,000 per investor per year, they will be deducting TDS on this at the rate of 10% at the time of distribution, irrespective of whether there has been any TDS deducted or not. At the time of filing, the investor has to add this dividend income to their incomes, and these dividends will now be taxable as per the slab rates applicable to them. So on the lower end, it could mean a 5% tax, and on the higher end, it could mean anything upwards of 30%.
Fair enough. Okay, let's get into the next segment, fixed income, and let's talk about fixed deposits and bonds, because I think this is where a lot of people go wrong, in that they don't account for the tax on their interest. It's essentially slab rate, and that could prove to be dangerous for people if they're investing large amounts of money, right?
Absolutely. And with the tightening of cross-reporting by by the banks or other institutions to the IT department, when one looks at one's 26 AS, which is the form where you are able to look at all the TDS that gets deducted against your PAN, most of these interest gets reported in the 26 AS. So technically, every investor has to, obviously all these incomes are taxable, and now that they are reported in 26 AS, so it has become very easy for the department to also look at whether these have been offered by investors in their returns or not. So for people in the higher tax bracket, investment in FDs or bonds would again be liable to slab rates. So typically for salary taxpayers who are earning more than say 10 or 15 lakhs, any interest that is earned on these FDs or bonds would end up being liable to tax at 30%. And generally, Alex, if I may add here, the disconnect that I see is many investors are aware that the bank or the institution is deducting some TDS, and they are like relaxed that I don't have to pay any more tax on this. But I would like to point out here that this TDS is being deducted at the rate of 10% by these institutions. Whereas at the point of filing, this interest income would actually be taxable at the slab rate. So whatever is the differential is what will become the additional tax outgo for these people to be paid at the time of their return file.
Understood. All right. Unfortunately, Arvind, we're running out of time because taxes across all asset classes is very, long, and it takes a lot of time to describe. But I'll very quickly take our viewers through the fixed income, the others that has to do with the mutual funds. Short-term capital gains occurs when you hold for less than 3 years, and that is taxed at slab rate. And the long-term gains, and this is why a lot of people say it might be more efficient to invest from a taxation perspective into bonds, if you're holding for more than 3 years, or rather into mutual fund debt schemes, you get 20% with indexation benefits. The reason I'm rushing through this is because I want to speak about real estate, Arvind. And this is where I think a lot of people go wrong, in that they don't necessarily estimate the cost of holding or the taxes associated. What advice would you have in this particular asset class?
I think as time has evolved, typically people end up only comparing the cost that they have paid to acquire a property, and they benchmark it against the realizable value of the property that when they look to sell it. But taxes invariably is a part of the cost here. But I think the bigger element which people tend to ignore is the incidental cost for holding a real estate, which I will count a few of them is the interest that one pays on the home loan that they acquire, home loan that they use to acquire the property, including the maintenance and property taxes, which invariably have been only going up over the last few years. So one has to really factor all these costs and the taxes that they have paid, as well as factor in the tax benefits that they might have got on this home loan interest. And only then can one get a real picture of the what we can call it as the real return that they might have earned on the real estate, rather than just loosely looking at the values invested and values realized.
Absolutely. And in fact, also people tend, because it's such a large value transaction usually, if you make even 15% gains on a 1 crore property, then you're making quite a lot of money. And usually in places like Mumbai, this is substantially more than that. So people tend to get a little bit blinded by the numbers there. Lastly, let's also speak about gold. It is the festive season. When you're talking about physical gold or otherwise, what are the taxes involved?
Well, physical gold is again very similar to the way you described for the debt mutual funds. That is, if you hold it for less than 3 years, it is short-term gains, which will be liable to tax at slab rates. If it is being sold after a period of 3 years, it will attract long-term capital gains, which is 20%, and comes with the indexation benefit for the cost. And with the options evolving for the modes in which you can invest in gold, namely the gold ETF, there is a slight difference there, because for ETFs, the holding period is 1 year, below which it becomes a short-term gain, and above which it's a long-term gain. And I think one of the more popular instruments is the sovereign gold bonds, which actually says zero capital gains if you hold it for an 8-year period. So yes, a lot of interesting taxation options in the gold space, Alex.
And final word, Arvind, on this, in that if you are looking at, say, a 5-year goal or a 7-year goal or a 10-year goal, and you're building in an investment growth or return of 12%, say, on equity, then should you shave off that bit of tax that you might end up paying when you're planning? Is that how you would plan your 3-year goals, your 2-year goals, your 1-year goals as well?
Yes, actually, depending upon the tenure for which you are setting aside the money. Depending upon the time period for which you are setting aside the money, we should shave off a percent of it.
Absolutely. Thank you so much, Arvind, for taking the time. Sorry, I rushed you in the end, where unfortunately we've covered quite a bit and I'm running out of time on this particular segment. Thank you so much for taking the time though, Arvind. It's always a pleasure speaking with you.
Pleasure is mine equally, Alex. Thank you.